Good morning. What a month. We saw a 14% correction from the August highs to the September lows. Fortunately, not something that happens every day. And also, fortunately, your portfolios did a lot better, with the high-risk funds only down 0.5% as our risk management processes continue to add value. There's a lot to get through today, but bottom line is we are buying the dip, and I'll take you through our reasoning in later slides. But before we get on to markets, a quick summary of the Sygnia Divi zero management fee class that's just been added and how to build a balanced portfolio at zero fee. And this is certainly very, very, very exciting for us. And we think it's a market first, being able to build a balanced portfolio at zero management fee. So looking at the underlying funds, and just to clarify, we have 3 zero management fee portfolios, one for each asset class, all slightly different. So the Sygnia Money Market Fund, that has a zero management fee until the end of 2022. There's a Sygnia All Bond Index Fund, which has a zero management fee until the end of 2022 as well. And now we have the Sygnia Divi Fund, an SA equity portfolio, and that's got a zero management fee forever. So it doesn't end like the other 2 portfolios. However, there is a performance fee. A ballot will be going out shortly. It should be 3 to 4 months until that ballot has been approved. And then there will be a zero management fee and a performance fee if the fund beats the Swix benchmark. If it doesn't, then there's no fee at all. Zero management fee and zero performance fee. If it does beat the Swix over rolling 3-year periods, then the performance fee will be paid. So we think this is very exciting, being able to blend equities, bonds, and cash to build your own balanced portfolio. Certainly a first for us, and we think a first for South Africa. So the question then comes down to, well, how do you build a balanced portfolio? How much equity should you have? How much bonds should you have? How much cash should you have? It's a very complex and difficult question, and I'm hoping to simplify it today and give you the backbones to understanding what you need in terms of that balance. And it really boils down to 3 factors. There are 3 factors that impact what your asset allocation should be. The most important is time horizon. Then there is also risk appetite and your surplus asset mix. And that's really income relative to expenses and then how much extra you have to spend each month. Now, I can't really give advice on your risk appetite or your surplus asset mix, your income versus expenses. That's something that either you need to talk to your financial advisor about or have a look at the robo-advisor on the Sygnia website. It's also quite useful. But what I can talk to you about is the time horizon. And that's certainly the most important of the 3 factors. Time horizon, then risk appetite and surplus asset mix. So when you're looking at the time horizon, or why does time impact how much equities or bonds or cash you should hold? It's because there are 2 main risks that you have to balance when it comes to investing: inflation risk and capital risk. And they vary over time. So let's look at inflation risk first. If you have money and you choose to put it under your bed, you are most likely going to be able to spend tomorrow what you spent today. So if today you could afford a loaf of bread, you put your money under your mattress, tomorrow you can afford a loaf of bread. But in 10 years' time, you'll probably only be able to buy half a loaf of bread. So that's inflation risk, which is eating away at your savings. The reverse is capital risk. So instead of putting your money under your mattress, you put it into the equity market. Now, today you can buy a loaf of bread. Most likely in 10 years' time, you'll be able to buy 2 loaves of bread for the same amount of money. However, tomorrow, you might only be able to buy half a loaf of bread because of the volatility that exists in equities. So deciding how much money you want to put into low-risk assets or high-risk assets is very dependent on your time horizon, which impacts whether you should be looking at inflation risk or capital risk. So if your time horizon is short, you said less than a year, then certainly capital risk is most important to you. You need to make sure that you can buy a loaf of bread tomorrow. So you put your money into cash or money market. If your time horizon is long, and in general, we say longer than 5 years, maybe longer than 6 years, then inflation risk is most important. You need to protect against losing the purchasing power of your investment. So you put all your money into equities. So Long term, 5 years or greater, you want to protect against inflation risk, you put all your money in equities. Less than 1 year, capital risk is more important. You need to spend your money quite soon, and you put all your money in cash. In between, so 1 to 5 years or 1 to 6 years, you're looking at some combination of equities, bonds, and cash. That'll obviously depend on time horizon. As you're closer to 4 years, there's more equities, and closer to 2 years, there's more bonds. But also that also very much depends on your risk appetite, your surplus asset mix, and that you need to look at the robo-advisor or talk to a financial advisor to understand what your income needs are, what your expenses are, and what risks you're comfortable taking. And wrapping that all together will then give you your final mix. And I really encourage you to do that. Look at robo, talk to a financial advisor, because now for the first time, you can build a balanced portfolio at zero management fee, which is very, very, very exciting. Great. So moving on to markets. September was certainly a risk-off month. There's a lot of red on the screen. You can see that the worst performing asset class, global bonds, and gold not doing much better. It's about halfway down, but also severely in the red. So we continue to avoid global bonds, and we continue to avoid gold in our portfolios because they're distorted by quantitative easing. And when it comes to needing protection, they don't give you that protection. And that's exactly what we saw in September. One of the risks that caused the pullback in markets was the concern of tapering or the slowing down of buying of government bonds by central banks. And that's what then led to not only a fall in a variety of markets, equities across the globe, but also your traditional safe havens such as gold and developed market bonds. So we continue to avoid those asset classes. The three asset classes that did do well this month was the dollar, and that's certainly one we do use, particularly when you're invested in rands. The dollar gives you some nice protection. Japanese equities, we do have a good exposure to that, and Brent oil, which seemed to do well because of the energy crisis. So some of the other factors that caused a big pull down in September, on top of the Fed tapering concerns, was China's property debt crisis. I'm sure you've all heard about Evergrande Property Group, which had a market cap of 25 billion, which fell to 5 billion and then suspended. They've got $300 billion worth of liabilities, and they have defaulted on some of their interest payments. And that had a knock-on effect on commodities. Iron ore collapsed, and any of the other copper collapsed. Any of the commodities are used to build property and invest in property development. We also had the global energy shortage, and that's pushed up natural gas prices, it's pushed up coal prices, it's pushed up oil prices, and the markets were concerned about that. Markets have also been concerned about Biden's tax hikes and the extent that those will impact earnings in the US. And then we've actually had some supply bottlenecks decrease, which have improved supply, but that's obviously pushed down prices. For example, palladium fell 23%. Part of that was because there's lower demand because of bottlenecks on the other side and automakers, but there was also increased supply. Bottom line, there was a lot to be worried about in September. It's tapering, China, tax, commodities, everything was all over the place. And I will go through in more detail each one of those as we go through the regions. But again, the bottom line is we think that this is a dip to buy, not a dip to cause any panic. And one of the reasons that we are bullish on markets over the next 6 to 12 months is that we think that economies will continue to recover. Certainly the vaccination campaigns have accelerated in emerging markets, which is very good. Yes, they've slowed in developed markets, but off a very high base. And that is leading to some convergence between developed markets and emerging markets in terms of mobility. But more importantly, we're getting to a point where the vaccine really is taking a backseat to other risks. As I mentioned, all of those risks that concern markets this month, the Delta variant or extreme lockdowns was not one of them. I think this is something that we are finally putting behind ourselves when it comes to investing. Yes, there are definitely still impacts. Markets aren't fully open, economies aren't fully open, but when it comes to severe lockdowns, I think that those are a thing of the past. So not only do we have vaccines that have been rolled out quite aggressively, but we're also getting to a point where herd immunity is taking impact. And most importantly, hospital utilization rates are way down. And I think when we get to a point where even if everyone is not vaccinated, but those who want to be vaccinated can be, those who choose to be vaccinated are, and this leads to a whole nother debate across the globe with how mandatory vaccination should be and anti-vaxxers, and I'm not even going to get into that debate. But I think what's important is that if people who want to be vaccinated can be vaccinated, then the political demand or need for lockdowns disappears. Those who believe in the vaccines will be vaccinated, and those who don't won't. But as long as the people who feel it's important have access to it, well, then we can move forward into a more, let's call it, diverse and dynamic way forward without stringent lockdowns that impact everybody. And how that looks is still uncertain, but at least we will have access to more of the economy. There will be improved travel. There will be improved access to a variety of services, and the economy should continue to open up. So yes, the recovery has been slower than expected. And yes, each additional wave of lockdown has slowed down the recovery. But it's also allowed the recovery to not get overheated. It's ironically extended this Goldilocks period where we can open up the economy, growth can recover, but it's doing in a slow enough fashion that it's not leading to any overall overheating, and it's not causing central banks to rush in and raise rates too quickly. Yes, there have been inflation, but that's been also linked to some of the bottlenecks, and that we are seeing that inflation is in fact also rolling over. So generally, we've actually been quite lucky in terms of where the economy is. It's still recovering. That recovery has been extended, even if it's slower. But because it's slower, it's not leading to overheating, and it allows us to keep our forecast, or extend our positive forecast for another 6 to 12 months at the very least. We don't see a recession in the next 12 months, which means that all else being equal, equity markets should go up, and we should get positive returns. Certainly not as positive as they were for the last 12 months, where we came off an incredibly low base, but we're feeling positive. And yes, there are and will be pullbacks. There's generally a pullback of at least 5% every year in markets. China actually has a pullback of nearly 20% almost every year in terms of since MSCI China was launched, so more volatility there. But volatility is something that is here to stay. Doesn't mean that markets won't trend higher. They will, slower than the past, but they will. So we continue to be bullish on the future. But as I said, we are expecting growth to be lower than it was in the past. Now I'm talking the next 10 years versus the last 40 years. We are expecting growth to be lower. We are expecting volatility to be higher. And I've spoken about this many times in the past. And some of the main reasons I've given are demographics, the fact that we've got shrinking populations, working populations as people retire, and as fertility rates drop. But also as debt increases to new all-time highs, and the more debt you have, and the more you have to spend on servicing that debt, and the more volatility and leverage that enters into the market as a result, that all slows down growth. But there's an additional factor that has been slowing down growth that I haven't spoken about much, and that's what I'm calling financial repression. Basically, it's the involvement of governments in markets and pushing out or squeezing out the private sector. And as you can imagine, governments aren't as efficient in terms of meeting supply and demand as the private sector is. The invisible hand of governments is just not quite as dynamic and fluid as the private sector is. Yes, you certainly need government to be involved. There's certainly certain sectors where they have to be there. Providing a social safety net is vital. And so I'm not saying that the government is bad. I'm saying the government's role is increasing to the point where it's becoming too large relative to the private sector, and it's crowding out the private sector in areas that have traditionally been working quite well. So what am I talking about? Well, I'm talking about quantitative easing, obviously. that's the major change to the market since the great financial crisis in developed markets over the last decade. First started by Japan nearly 25 years ago, where governments started to buy, central banks started to buy their own government bonds to manipulate the cost of borrowing money, to encourage people to borrow, so people would borrow and invest and create jobs. It's all about creating jobs and avoiding recessions. And from that perspective, quantitative easing has worked well. We've had some of the fastest recoveries from our drawdowns. Certainly was the COVID recession was the fastest recovery ever. And the recessions that we've had, or wobbles we've had over the last decade, have all recovered very quickly because of the huge amount of stimulus that central banks have pumped into the market. And the chart on the right really shows that. I mean, it's quite astounding. And we all know about the US. The US has got the largest stock of government bonds that they have bought in terms of the central bank and their QE. But you can see that they earn about 25% of the outstanding bonds. What's quite a surprise to see is who's top of the pops: Australia and the Euro area. Japan, you expect to be up there, earning more than half of their outstanding government bonds, 50%. But quite a surprise to see Euro area, Australia, New Zealand, UK, all close to 50% of the outstanding bonds they now own. Basically, extra demand coming in, they're buying bonds where there is no demand, pushing down or pushing up the price of bonds, which pushes down the yield and allows bonds to trade, or you can borrow money cheaper than otherwise you should be able to. Canada and Sweden next, they're sitting there around 30%, and the US at 20%. Now, the big thing is, and when I say financial repression is continuing, is that you can see all of these line charts. The only time the lines have ever come down was roughly in 2018 in the US, where they tried to, for a brief moment in time, sell some of the government bonds, or just not even sell, just let them mature so that their balance sheet shrank. But that had a terrible impact on markets. And so right now, while we're talking about tapering, and this month is all about tapering at all the central banks, the Fed, the ECB, it's all about tapering. But they're not even talking about selling. They're just talking about doing less QE, buying more at a slower rate. So they're continuing to buy bonds, and that continues to impact markets. It continues to impact, obviously, bond yields, which then impacts gold, and indirectly every other market which is priced off bond yields. When you price future cash flows for an equity investment, it's discounted back at whatever the cost that you can borrow. So when governments can influence their borrowing rate, well, it influences everything. So what is the issue with QE? Yes, QE has been good in terms of keeping us out of a long-term depression or recession. However, it has pushed down the cost of borrowing money, which has pushed up all asset prices: house prices, gold price, equity prices, bond prices, art, Bitcoin, gold, whatever it may be. They've all been pushed up because you can borrow for less, which is great if you own assets. So if you're retired, you're sitting pretty. You not only do you have your income that you were earning off your retirement, but your retirement assets have doubled or tripled in value. Not great if you are a first-time earner and all of a sudden it costs a lot more to save. You're buying your saving assets, you're buying your shares at half the dividend yield. You can't afford to buy a house. You're still living at home because all the asset prices have been pushed up. So, and in fact, it gets really bad in terms of this tax on saving. I mean, in South Africa, we're lucky. We've got our own issues, and as a result, our bond yields are still relatively high. So you can take out a guaranteed annuity, which will pay out until you die, and you're probably looking at about a 10% yield on that, which is quite phenomenal. So you invest 100 Rand, you're earning 10 Rand each year, and you can spend that 10 Rand, you can live off that 10 Rand. If you're in Japan or Europe or other developed markets, you're getting zero on your annuity. So you're going to have to live off capital, which means you have to save a whole lot more because there's no yield anymore. You're living off your capital when you're retired. So you have to save a lot more, double what you have saved before, so that you can actually afford to retire. So that's why I say QE is a tax on savings, because you need to save a lot more because your yield's a lot lower. It also has the indirect impact of people have to save more, so they spend less, and then growth is lower. And there's a whole lot of influences that are unintended. The other big unintended consequence is widening of the inequality gap. I mentioned that earlier, but basically, if you were a have, particularly if you're retired and you had a lot of assets, well, those assets went up. If you were a have not and you just finished varsity and you had a huge amount of debt and no assets, well, unfortunately, I suppose the cost of your student loan came down slightly with interest rates, but the cost of buying any assets to retire went up. So governments have realized that, and there's obviously been a lot of social unrest and pushing back as people have realized that. The man on the street has not done as well as people with assets. And so governments are doing all they can to offset these unexpected and unwanted consequences of quantitative easing. So there's a lot of fiscal support. And Japan's been doing this. I mean, again, they are a poster child. They've been doing this for the last 25 years, along with QE. There's been fiscal support. They've been building roads, railways, whatever they need to. China is the same. They've just been building property. Apparently 1/5 of Chinese apartments are empty. But as long as you are building, you are driving your economy, you're keeping people employed, you are trying to avoid a recession, you're trying to keep the politicians in power without any social unrest, which is the main driver. So this is likely to continue. But to afford these fiscal programs and the COVID support initiatives, well, you need more taxes. And now you've got a shrinking tax base because people are getting older and they're retiring. So you've got to push up taxes even more. So your second part of financial repression is not just a tax on savings, but a direct tax, most of which is a wealth tax to try and alleviate the tax or the benefit that QE has bestowed on certain parts of the economy. But all taxes are going up, including that, to try and pay for the fiscal programs and to try and drive employment. Because again, it's not just fighting the QE, you're also fighting aging populations and growing debt levels, which are all bad for investment and bad for job creation. And the third financial repression, which is linked to the second, is other ways that governments are trying to drive employment, job growth, and that's, if not directly through taxes, then it's through prescribed assets or involuntary prescribed assets such as retirement fund partner projects. They're trying to use pools of assets that aren't linked to tax that they can use to build airports and railways and harbors and hospitals and anything else that hopefully improves the economy slightly, but most importantly drives job creation. And I have mentioned before that we have got to the point of extreme diminishing marginal returns where before, 80 cents of every dollar of debt, every dollar of debt led to an 80-cent improvement of GDP. That's now down in Japan down to 20 cents. So certainly where this increased role of government leads to a reduced GDP improvement. But that's because that's the secondary nature, or the secondary goal of all these investment drives. The first goal is to create employment and to make sure that everybody has jobs, that everybody has food, and everybody is looked after, which is certainly a very important need. Sure, so that was a lot. Sorry, the bottom line of this chart is have a look at the amount of QE that's in the world. It is massive. So it's not just debt. I mean, we are massive levels of debt because of the fiscal drive and trying to support the fiscal needs of various governments. But quantitative easing is also massive, and the amount of bonds that governments are buying is massive, and it all feeds together. The governments need to issue bonds to build a bridge. If they issue bonds at a very high interest rate, well, they can't afford to. But as long as the government or central bank, which owns the government, is buying those bonds, interest rates stay low, so they can then build a bridge at a very low cost. So you can see how the independence of central banks becomes very blurry. Yes, central banks are mostly independent, including South Africa's and Japan's and the US, but it's not as clear cut, and that independence is just looking blurry as as capitalism and socialism and all of this sort of blurs into one, and we move into this new era of much larger government influence in the world. And some countries do it better than others, but it is where we are. So one thing I forgot to mention on the previous slide, when we're positive about the outlook for growth over the next 6 to 12 months. And that's why we are overweight value in the short term. We've got US value, we've got MSCI value. Locally, we've got our Divi fund, which has value. All of these value aspects we think will do well as growth recovers. However, in the long term, we keep our strategic asset allocation towards our satellites, our growth satellites, which are growth funds or satellites which will continue to grow ahead of the market, in a market which is seeing low growth. So those are areas that, despite low total growth, we'll see market share gain. Healthcare, technology disruptors, emerging Asian middle class, all areas that will continue to grow despite a lack of growth in the rest of the world. So positive in the short to medium term. Longer term, less positive. Well, there's going to be a lot more volatility, and we harness that volatility in part of our risk management process, but also make sure you have allocations to the growth satellites. So as I mentioned before, it's all been about tapering this month and buying more bonds at a slower rate than in the past. And Jeremy Powell was talking about that at the FOMC meeting this month. He said that tapering could come as soon as the next meeting, which is November. So that is very soon. But they are just going to be buying less. And it's incredible how much quantitative easing has happened in the US. In the US, the Fed's balance sheet is sitting at $8.5 trillion. That is such a vast number that it's hard to understand. But what it means is that they've been buying treasuries at the rate of $1 a minute. That is quite phenomenal. To get to $8.5 trillion, you have to buy, they've been buying $1 million of bonds every minute. I mean, it's just staggering the size of the bond purchases and the quantitative easing. And you can't ignore the influence it's having when when it is to this extent. It's just numbers that are hard to get your head around. But as I said, the tapering could happen as soon as November this year, and that's despite inflation rolling over. So the chart here on the right shows how inflation, which was in July, month on month, core inflation in the US was at 0.9%. That's fallen to less than a third, it's now 0.27%. Very much almost back in line with so you look at the gray areas here, nearly back in line with your long-term average US core CPI, certainly in line with the target average of 2%. And that's been allowed due to negative inflation from airfares, hotels, and admission to events, but also a small negative to vehicle rentals, new and used vehicle prices. So new and used vehicle prices spiked quite aggressively because of the chip shortage, and we are seeing the price of those chips come down. They started to roll over and slow down, and that as well as a slowdown in people buying vehicles, that has led to a rollover there. There are still bottlenecks, and the biggest bottleneck at the moment is it was caused by one of the Chinese port closures due to COVID, and that led to a spike in shipping rates. Shipping rates are still very high relative to history, but they are again also rolling over, and that should feed out of inflation over the next 6 months. And although inflation has been a little bit more sticky than everyone thought, it certainly still looks to be transitory, with wage inflation in particular not pushing through, certainly in the middle to upper parts of wages. The lower end, entry end of wages is seeing some quite aggressive increases, but again, that's the area that corporates, particularly in the US, are quick to replace with machines if they have to, and hasn't in the past led to long-term inflation consequences. So right now we think that inflation will continue to be transitory. Commodity prices are also rolling over. Yes, we are seeing a spike in oil and natural gas, as there's a shortage in Europe and the US and China. There's an energy shortage at the moment, but again, that's short term. It's a lot of buying ahead of the northern hemisphere winter. Certainly, a lot of panic buying that is being seen. China in particular, and it's just said buy at all costs, and that's pushed up coal prices and natural gas prices. Those will roll over when we get to winter, when the panic is past. So some transitory inflation. There's a little bit more to come, but it looks like inflation expectations are under control. Certainly, longer-term inflation expectations aren't a cause for concern. Despite that, Federal Reserve Chair Jeremy Powell did say that they are going to start tapering in November, likely to finish tapering in the middle of next year, which means that the first rate hike has moved forward slightly from the beginning of 2023 to the end of 2022. And that is one of the reasons why markets came off this month, why gold and bonds were down in the month of September. We remain underweight the US. We've got about more than 10% underweight US compared to our benchmark. And that's for a number of reasons. It's partly because of the valuations in the US, which are looking stretched. It's partly because of the dollar, which we think will continue to be weak as the rest of world growth recovers. We also are concerned about Biden's tax increases, and if those aren't being priced into forward earnings that analysts are putting out. And there's a lot of antitrust issues that are coming out. I think that nearly the entire world was impacted by the Facebook outage yesterday. We are also likely to see Facebook testifying shortly about impact its platform has on children. Certainly the impact it has on people's emotional well-being is a big cause for concern going forward. In addition, Apple's new privacy rights, that has impacted advertising revenue. Facebook is experiencing big headwinds on advertising headwinds as a result of the latest iOS updates, which have seen increased privacy settings, which has then reduced Facebook's advertising revenues. So we do think that there are some headwinds to come to the big tech companies. And that's one of the reasons why, although we still have decent exposure to all these great monopoly companies in the US, but we have been increasing our exposure to China tech as well, which is certainly pricing in a lot more risks right now than the US is. Looking to Europe, we have Christine Lagarde. She is quite something, and she says the lady isn't tapering. Again, talking about tapering, but she's saying it's not tapering, trying to avoid what happened in the US in 2013 with the taper tantrum. And so they've just called it something else. It's exactly the same thing. The ECB is slowing down the rate at which it's buying bonds. So they are still buying bonds, just at a slower rate. And they've decided to call it calibration. So the ECB has calibrated their bond buying. They've decided that if they call it something else, the market won't panic because it's not a taper, it's a recalibration. And it seems to have worked. The market wasn't concerned about their recalibration. There was no taper tantrum. You can see on the chart on the right how the ECB balance sheet has nearly doubled since the beginning of the COVID pandemic. So the last 18 months, it's increased by 3.5 trillion euros. Again, a massive, massive amount. And going into Q4 of this year, they will be slowing down the rate at which they are buying bonds. Still growing that balance sheet, but at a slower rate. Still distorting markets, but at a slower rate. We do like the euro area. We are overweight the euro area relative to the US. And that's partly because underperformance of the stocks 50 and European markets, as well as improved earnings, has seen the valuation gap to the US stretched to the largest that gap has been over the last 10 years. The ECB is also looking dovish, and fiscal policy is looking relatively strong in the euro area. So when you've got a dovish central bank, easy money, strong fiscal support, as well as cheap valuations and strong earnings, well, that's the best recipe you can get for equity. So we are overweight the euro area, and we think that will do better than the US going forward. Now, most of the noise that we had in September was about China. And here we have President Xi talking about common prosperity. And while common prosperity is something to be concerned about, it is also something to be grateful for, because it is one of the reasons why the Evergrande default is not going to be allowed to be a systemic event in China. Sorry, excuse me 1 second. I'm back. So while common prosperity was a big concern for tech companies, it is actually looking quite positive in terms of its impact on the rest of the Chinese market. So we remain positive on China. There are a lot of concerns. That's generally the right time to be positive, is when there are a lot of concerns. The Chinese economy continued to weaken in August, and that was on the back of stringent public health restrictions because of a COVID outbreak that happened there, the Delta variant, that is now under control. And we do think growth will recover on the back of more mobility from a COVID perspective. But generally, we are positive on China. And there are a lot of points here, and I'll take you through all of them as to what those risks are and why we think that those risks, to some extent, are mitigated and to all extents are priced in. So the first is the tech companies, and that was the rollout of common prosperity, which impacted the educational companies in particular, and advertising and marketing to a lesser extent for some of the big platform companies and gaming as well. But all of those concerns were done to protect the people of China, the emerging middle class that is so important to President Xi, and certainly some of those are things that other markets could see. And yes, in the US it might take 10 years to get there, but the negative impact that gaming and social media is having, if unchecked, is certainly something that needs to be worried about. Now, in particular, China is not going to try and dismantle their large tech companies. The big war, the next war over the next decade between China and the US is a tech war. That is the focus. It's all about R&D. It's why China's 5-year plan is seeing huge amounts spent on R&D. They want to become the technology leaders of the world. They want to take on Silicon Valley. They want to take on the US. And they can't do that if they destroy their tech companies. And in particular, it's much easier for them to monitor what's going on if there are just a handful of large tech companies, and they can keep a close eye on them and manage their policies. So we think China will use their tech companies to take on the US. They won't dismantle them. And this was confirmed when China's top regulators met with Wall Street executives this month to reassure them that they are not trying to stifle creativity. They're not trying to stifle the private sector. And they're not trying to stifle profits. So profits will be allowed to continue in China for the bulk of areas, provided that there aren't any obscene profits that are occurring where people are being abused. And that, I think, leads to a more stable and sustainable future for Chinese tech. So Chinese tech, we think that a lot is priced in. These are mostly good measures, and they should lead to a more stable future. Then Evergrande. Evergrande is a major concern. Certainly is. I mean, they're sitting on over $300 billion of liabilities. And the property sector, and particularly construction in the property sector, has been one of the big drivers of growth in China. What is interesting, and what is you don't see, if you strip out other fixed asset investments and you look just at the property sector and the growth that was being driven from that in terms of fixed asset investment peaked 5 years ago. And it's now half the levels it was 5 years ago. So although it's still important in Chinese growth, it's actually half the size it was 5 years ago. So China has done a lot to realign the economy already, which is great. And we will see more defaults, and certainly there have been smaller property companies that have defaulted and followed on the back of Evergrande in terms of their default. But common prosperity will not allow China's government to allow this to cause a systemic event. In fact, it won't even allow this to disrupt the property sector. Yes, there will be more defaults. There will be some companies that go bankrupt. the government is not out to protect shareholders or bondholders, but they are out to protect the economy. So in terms of a systemic China event, we don't see that happening. In fact, we think this is a buying opportunity because a lot of risks can be priced in, but barring Evergrande and a couple of other property companies which might go bankrupt, the property sector as a whole will continue because construction has to happen. It's one of the employment growth drivers. And it is certainly something that is important for common prosperity. So there, the will of China will allow this to continue in a measured event. There will be more wobbles, just as there have been more tech wobbles. So I'm not saying we're through the worst, but it's not going to lead to a Chinese blow up. And we can see that already happening with Chinese policy. So China in July, they reduced the reserve ratio requirement. So the chart on the right here shows that the black line, which is ticked up, that's excess reserve ratio, and the green line, which is the credit impulse that's likely to follow. And when the credit impulse follows, the economy follows, and commodity demand follows. The falling of this green line is why we have been underweight equities over the last. One of the reasons we've been underweight equities over the last 6 months. One of the reasons we've been concerned about the rand, in particular in the short term, and commodities mostly in the short term, and we have seen that happen. We've had commodities have fallen in South Africa. Resources are down over 20% this year. A lot of that risk took a while, but it's been priced in, and we've now gone neutral on our equity allocation. We have bought the dip, and we may continue to buy the dip, although we're monitoring going forward. But we think that this is a major driver. I mean, Chinese economy is, on a purchasing power parity basis, is the biggest in the world. Yes, they've got a much smaller impact on markets compared to the US, but when their economy turns and it looks like it's bottoming, well, that's very good for not just China, but the whole of the East and Europe. So we continue to be bullish on those areas. Now, one of the reasons we had an energy or are going through an energy crisis this month is certainly, from a China perspective, was the Olympic Blue Sky project. So China is hosting the Winter Olympics in February next year, and just as they did when they held the last Olympics, they wanted to make sure that people could breathe the air when they arrived to visit, which makes sense. So they shut down, or the National Development and Reform Commission shut down the 20 largest cities and provinces. They had their coal power producing facilities shut down to try and clear the pollution and clear the air. Obviously, that led to a shortage of energy, and they had to move to cleaner energy, such as natural gas. And that's one of the reasons why natural gas prices and oil prices have skyrocketed, is China's move away from coal over the last couple of months to try and clear the air ahead of the Winter Olympics. Certainly an easy trigger for them to pull. They can easily switch back to coal if they need to, but they are unlikely to do so until February, when the Winter Olympics happen, unless it becomes a major constraint on growth, and then they will. So again, it's just like common prosperity. The headwinds that China faces are headwinds that China creates in a bid to try and balance out the economy, whether it's from an environmental perspective or a debt perspective or a growth perspective. As easy it is for them to pull the trigger to create those headwinds, it's equally as easy for them to remove those headwinds. And then it all comes down to pricing. So in terms of risks, it's not only the risks, but it's the reward potential for those risks. Emerging market stocks trading at a Schiller PE, which is a long-term PE of 15. The US has a similar PE, Case-Shiller PE, or comparable Case-Shiller PE of 37. It's just a staggering number in terms of US valuations. Europe is looking at 22, much closer to EM of 15, nowhere near US of 37, and Japan on 24, also closer to the lower end than the upper end. That's why we remain overweight Europe, overweight Japan, underweight the US, and overweight emerging markets. In fact, the emerging market discount to the global index is the highest it has been in the last 20 years, driven mostly by the China tech rout, but also a little bit by the Evergrande concerns. And an interesting factor is to look at flows. So, how much of Chinese bonds and Chinese equities are owned by foreigners relative to their GDP, and looking at the comparative number in the US. So if you take the total number of Chinese bonds and Chinese equities that are owned by foreigners, that works out to be 8% of their GDP. So roughly 1/10 of their gross domestic product that happens each year, foreigners own that or are entitled to those revenues. In the US, that number is 80%, 10 times. So the US is generating gross domestic profits and the profits that are associated with that. 80% of those revenues go to foreigners, and that's quite staggering. And it may just be a sign that maybe the world owns too much of the US and not enough of China. And that's one of the reasons why we are comfortable being overweight China and not the US. And that's relative to GDP as well. I mean, you can similar ratios to look at this. The weight of the US in the MSCI world compared to well, I mean, the MSCI world doesn't have any emerging markets, so there's no China at all, and the US is 70%. So if you're using MSCI world as your benchmark, well, you're looking very skewed. And then lastly, one of the reasons that we're not as concerned as we have been in the past is emerging market currencies are running current account surpluses, and that's mostly because of commodity prices being higher. And we don't see commodity prices crashing like that last time. Yes, right now, iron ore and platinum and palladium have collapsed, and copper. That's very much China driven in terms of the slowdown there, or concerns there will be a slowdown in the property sector. But natural gas and coal, those are, and oil, those two are previous all-time highs. Oil's at a 5-year high. So there's a bit of a mixed bag when it comes to commodities, but we're not seeing every commodity at their lows, which is what drove the EM crisis a couple of years ago. So generally, we remain positive on emerging markets. It is our largest overweight. Yes, things have been tough, and it is one of the reasons why we have topped up the area, although we did top it up, as I've mentioned before, just in the Chinese tech sector, as that was looking the most oversold. And that brings us to South Africa. So we had our Reserve Bank governor, but again, we had ECB, we had the Fed meet, and we had our MPC this month as well, where rates were kept unchanged, which is great news. Certainly, we didn't want interest rates to start to go up in South Africa. The repo stays at 3.5%, which is great. But some of the concerns that came through, and hopefully this is there is the SARB just trying to talk their book, and hopefully they don't push rates through as much as they want to, but they are saying that their models are forecasting that by the end of 2023, so 2 years out, interest rates will be 3% higher. So they will raise the repo from 3.5% to 6.5% over the next 2 years. That is quite something. I mean, that's doubling of your interest cost over a 2-year period. I don't think our economy could actually handle that. Certainly, it'll make real yields really high compared to our inflation, forecasts, which are only about 4.5% over the next 2 years. So it'll lead to a 2% real yield, which would be great for cash and credit funds, but I don't think it'll be that good for the economy. So hopefully, that is more to scare people and to try and keep inflation expectations under wraps. And we'll see what happens. Certainly, there will be an increase, but we're pricing in 2% rate hikes for the next 2 years, not 3%. But let's see what happens. And then talking a little bit about South African equity. So I mentioned on the first slide in a balanced portfolio, if you have a long-term time horizon, generally greater than 5 or 6 years, your main concern is inflation risk, and that you could, when you want to buy a loaf of bread in 10 years' time, you can buy at least one loaf, preferably 2 loaves, but you're not stuck to only buying half a loaf because inflation has eroded away your earnings. And how to avoid that is you invest in equities. Now, our general rule of thumb is to put 2/3 of your money in SA equities and 1/3 of your money in global equities. Now, this is definitely very broad, and you could say money that you want to spend in South Africa, you keep invested in South Africa because that matches your assets and liabilities. Monies you don't need to spend, as in surplus assets, well, that all goes to global, 100% global. Trying to figure out how much surplus money you have, well, that's not possible. You can make guesses, but you don't know if you're going to be retrenched. You don't know if you're going to have an addition to the family. There's so many uncertainties that it's very difficult to forecast. So, I think the safest thing to do, in our rule of thumb, if you don't have that uncertainty, and if you've got hundreds of millions and you know that you definitely can't touch it and it's in a trust for whoever, well, fine, then that money can be invested globally. But for most of us, where you don't know if you're going to have enough money to retire, you don't know if you're going to have surplus assets, well, then the safest thing to do is 2/3 SA, 1/3 global. And again, talk to a financial advisor, use our robo tool. It all depends on risk appetite and your own income versus expenses, but as a rough starting point, it's 2/3, 1/3. So you might say, well, South African equities, do we have to invest in South African equities? And while we are underweight South African equities in our balance portfolios, it is still our biggest allocation. So our flagship fund, which has a target of about 70% equities, that is, even though we're underweight South African equities compared to our benchmark, we're still sitting on about 45% South African equities, and nearly double our global equities. So it is still important to have an allocation, not only because it matches your liabilities and it's best to have RAND savings with RAND investments, but also for a number of other reasons, including valuation. If we look at the chart here, that's the forward-looking PE ratio, and our markets are the cheapest they've been since 2009. And you may say, yes, for very good reason, Kyle, because we have some serious headwinds. We've got the highest inequality in the world, and we've got some structural headwinds, energy shortages in the short term, and now we've had another delay to the emergency power bids, which it's been delayed by another 4 months. So who knows when load shedding is going to end. Our education system is broken. We've got the highest or the worst education scores in the world. That leads to long-term structural issues. That is a problem. And I'm not going to argue with you at all from that perspective. However, the flip side to that coin is that when there is fear or lack of trust, and there's certainly a lack of trust right now in South Africa, there's no investment. People do not spend. They take their money offshore, they keep their money in cash in the bank. They don't open up another branch of their franchise. They don't build another factory. They don't raise employment. They don't take on risk because there's uncertainty. Foreigners don't enter the market. You don't find new brands competing with your local brands. You don't find new banks coming in, global hospital groups moving in. There's too much fear and too much uncertainty. So what happens is that your established players, the big guys, tend to form an oligopoly. And we have 4 or 5 big banks, 4 or 5 big life insurers, similarly with the retailers, 3 or 4 big retailers, food retailers. So when things do recover, and there is a recovery and growth, and we will go through recovery and growth when we come out of the COVID recession, well, those guys will do really well because they don't have competition. And there will be some excess returns, just as we are seeing in the resource sector right now. The resource sector was looking horrendous, but they are now seeing super profits because there hasn't been an increase in supply. There was concern about a lack of trust. There was no investment in new supply. So when the demand came, commodity prices were pushed up, and Kumba and Exxaro and the platinum miners have all made super profits and declared huge dividends and massive bonuses and employed a lot more people and raised wages. So while we've got some serious headwinds, and while you would have been done very well to be underweight South African equities as we have been, we have closed our underweight to only 1%. We are thinking about going neutral on the back of valuation and the fact that we are getting closer to reforms happening, even if it is much slower than we thought. So yes, while we remain underweight South African equities and we remain underweight the Rand right now, a balanced portfolio needs to have some cash, some bonds, and some equities. And within those equities, you do need to have some South African equities. if only from a regulatory perspective on your RA, but generally we think it's a good idea overall to have a decent balance and match your assets with your liabilities. Similarly, on the fixed income side, we remain overweight bonds because the yield curve remains steep. So we overweight bonds, underweight cash and credit. That's in all our balance funds, and our income maximizer has the same outlook. It is overweight bonds. In fact, we topped up bonds slightly more and reduced credit a little bit more as bond yields did increase. You would have seen that fund had its first negative month last month on the back of bond yields weakening, prices weakening and yields going up. And so we took advantage of that. We do think that the budget will be good. We've got the budget next month in November, and although expenses are going to be higher than expected, revenues also going to be higher. Although they're not going to be massive decreases to our debt to GDP forecast, they are going to likely remain stable, which means that bonds are unlikely to sell off because supply won't increase more than expected. And so that brings us to our positioning slide, which is, as it has been, a small overweight to our bond alternatives, because we have no gold, we have no global bonds. We do have some global property as an alternative, small allocation there. The Sygnia Global Property ETF, which has had a phenomenal return year to date. We've got a small allocation to disruptive technologies in terms of the Fourth Industrial Revolution Fund. We've just had our new tech fund approved. It's probably going to take 8 months to bring it to market, unfortunately, but we've got a fantastic and very exciting fund coming this way in the sector. So we do have the FANG fund, Fourth Industrial Revolution Fund, and we are going to launch another fund there soon. Watch this space, very exciting. Emerging Asia, that is our biggest overweight, but it is very well diversified. So we've got the bulk of that in emerging markets, which has got a nice exposure to Korea and Taiwan, which have got semiconductor exposure, which is doing really well. We've also got some exposure to Chinese mainland A shares, which don't have any internet stocks and have been relatively well shielded. And then we've got MSCI China as our third pillar in the China strategy, and that we've only just bought after a 40% pullback. That has MSCI China, 44% of that is internet stocks, and so nearly half. So basically, we're getting our tech exposure through that. Very liquid, very low cost, had a massive pullback, and we do like that exposure. Not something we'll probably hold long term, but definitely we expect a decent bounce out of that section. Healthcare, strategic long-term holding, both in our Health Innovation Trust and our Healthcare ETF and OSI. All three continue to do well, and we are bullish on them. And then value, as well as MSCI value and US value, we also now have our value proxy, our Divi fund locally, to get some value exposure over the next while. And that is a wrap of positioning. Sorry, it's taken a little bit longer than I expected, so I will go over 1 hour to look at some of the questions. Let's have a look at some of these questions. A question on China. So as I reiterated, we've got MSCI China, which has 44% internet stocks. And we have the A share China, and we've got emerging markets, which also has an exposure to China. So we've got China exposure through 3 different avenues, all of which we've got different entry and exit points for, because they've all got different drivers. So a question from Books Funded Linda: how do I, as an individual, invest in EM and Europe through Sygnia? Well, we have the Sygnia Itrix Europe, Eurostoxx 50. So it's the code there, if you want to look, is SIG-EU. And we've got the Sygnia Itrix Emerging Market 50 Index. Also another ETF, which the code there, if you're looking on the JSE, is SIG-EMF. So 2 listed ETFs to get exposure to Europe and emerging markets. And as I said, we are overweight both at the moment in our balanced portfolios. EJ asked about the planned delisting of Chinese companies on US exchanges. We don't see this as a risk. This is something Trump threatened to do. a while ago, and as a result, China decided they would take that into their own hands. And so a lot of those Chinese companies already have listings in Hong Kong. They'll be moving the primary listing from the US to Hong Kong over the next while, and you'll probably see more delistings happening. Not a problem. We trade extensively in Hong Kong already. It's in most of our portfolios, so we can get access to those counters. And you're already finding that some of the index trackers, such as MSCI, they are moving the holding from the US to Hong Kong already. So there won't be any impact on index weights. There won't be any impact on access to those shares. It just means that the US won't be able to control whether you can buy or not buy those counters, which we think will reduce volatility. So we think it's a very, very big positive step, the move to Hong Kong. In particular, even now, there are some Chinese companies that we'd like to buy that are sanctioned, and you can't buy because of the US sanctions. When I say we're overweight Europe or underweight Europe, that is relative to our benchmark. So all our balanced funds have strategic benchmark, and that's in some cases MSCI All Country World. In others, it's a slightly different benchmark, but we're generally talking MSCI All Country World, which has roughly 20% allocation to Europe, 60 to the US, 10 to Japan, and 15 to emerging markets. I don't know if that adds up to 100, but that's MSCI All Country World. We could check out their weights on the MSCI website, look at the fact sheet, or look at our fact sheets for our benchmark weights, and we take over and underweights related to those. Wayne asks a great question about when interest rates start to reverse, just how drastic are they likely to be, and will QE respond accordingly? So the Fed have gone out of their way. They learned a valuable lesson in 2013 with the taper tantrum. And so they've gone out of their way now to decouple tapering with interest rate hikes. So tapering will happen first, and only after tapering will interest rate hikes happen. This is to try and avoid a taper tantrum. ECB have called it recalibration, again, to try and avoid a taper tantrum. So that is likely to not lead to a drastic disruption of markets. However, what it will see happen is that the tapering is going to lead to less bond buying, less bond demand. So, classic economics story, if you have lower demand relative to a fixed supply, your price goes down, yields go up. And it's one of the reasons why we do think US bond yields will go up, not only because growth is going to recover, but because there's going to be less demand for bond buying and relative supply, which will push yields up. So this is why it's very important to pick, although we are positive on markets, it's very important to pick the right parts of the market. Parts of the market. So banks will do relatively well. Industrials will do relatively well. And emerging markets will do relatively well. EM and Japan will do relatively well. Tech will do relatively poorly, and the US will do relatively poorly. All of those are generally what happens when US yields start to rise and the yield curve starts to steepen. So we've made sure that we've got, and value will do relatively well, as well as cyclicals. Defensive and growth won't do as well. So in the short term, we've positioned our portfolio for the negative impacts of tapering, which should have a larger negative impact on the US. So there was also a question that came through by email, thank you, about is the US going to crash? And it's a great question. It's a fantastic question, because when the US sneezes, the rest of the world catches a cold. So when the S&P falls, the rest of the world does poorly. That is how everything happens. But we don't, despite the weaker dollar, despite stretched valuations in the US, despite antitrust issues, despite all of the concerns that we have, we don't see the US crashing. It's not going to go into a recession. Growth is still too fragile to allow a recession. What we do think will happen is that the US will underperform. And we're already starting to see that. In the last couple of days with this pullback that's happened, the pullback was much larger in tech, much larger in NASDAQ, much larger in the S&P. In fact, we had some days when the S&P was falling and China was going up. So we're starting to see a decoupling of markets that, provided we don't see an all-out recession, in which case, yes, everything will fall. And we might even see Europe and Japan and emerging markets fall more than the US, because the US is the safe haven. Provided we have this recalibration and tapering that happens across the world as yields slowly start to rise. The US will move sideways, maybe slightly up, but it will lag the rest of the world. So that we're expecting more a lag to happen than a correction in the US. And that is also supported by valuations, with the US sitting a lot more expensive than the rest of the world. So we don't think that, well, we do see the market now as a buying opportunity, and if you like the US, you can buy the US. It still makes up roughly half of our global portfolios. We've been using our dry powder, we've been using our increase globally to buy emerging markets in particular, but value as well. So MSCI value and emerging markets and China. That's where we've been spending our money. So again, US inflation will drive first the tapering, the reduction in bond buying, which will push up the yield curve. After that, if inflation is still there, you'll have interest rates rising, which will push up the front end of the curve. That leads to a curve flattening, which is actually quite bad. You could see markets falling on a curve flattening. Markets like a curve rising. So that's why we think right now with tapering, it's better for markets. In a year's time, when we see interest rates come through, or just over a year's time, if the US is not ready for those interest rate increases, we could see some headwind to markets. But right over the next 6 to 12 months, we don't see that coming through. But yeah, the next big concern, and one risk we do monitor continually, is when will US raise rates, and will they do it too soon? We think that end of next year is not too soon, and that the economy can handle it, and as a result, the markets can handle it. A good question on the divvy fund. So divvy fund is 100% equities. Skeleton balance 60 and 70 are balanced funds. So they only have 60 or 70% equities. So choosing between those two, Mike, that depends on how much volatility you're prepared to expect and what kind of return you want. So divvy fund, more equities, 6 or 7 year time horizon, more worried about inflation risk. Skeleton balance 60 or 70, you've got some cash and some bonds, slightly shorter time horizon, balancing capital risk with inflation risk. Then it's also, again, important, if you want to use it in your tax-free savings account, skeleton balance 60 and 70, that's A class. The divvy fund is also, sorry, hang on, I could stand be corrected. It might actually be, I'm not quite sure, sorry, it might be the B class for those funds. But generally, the funds that have performance fees aren't allowed to have tax-free savings accounts. So on the divvy fund, the existing A class is for the tax-free savings account, and the B class, which we're launching, a zero fee, because it will have performance fee eventually, is not for tax-free savings account. So just keep an eye out on that. Generally, for most of our funds where there are performance fees, it's a B class that has no performance fee, and that's the class that uses the tax-free savings account, but not the case for all funds. Okay, outlook for EJ asks for outlook on local bonds. We are overweight local bonds. We do think that volatility will stay high. So we've got 2 mixed bags. Normally, in fact, up to now, it's been global money has supported global yields, or QE has pushed down global bond yields, which certainly keeps our bond yields lower because we are priced relative to other bonds. And then we've had massive blowouts in our budgets, which have pushed up our bond yields. We're now looking at that reversing slightly, where tapering across Europe and the US will push up global bonds, which then our bond yields will try to rise instantly. But because of the great profits from resources and hopefully a balanced budget coming up, we actually will have the domestic side keeping our bond yields from rising too high. If we have a bad budget, then we could see our bond yields rise further from here, which should be bad from a pricing perspective and volatility perspective. So we actually we're no longer benefiting from global moves. Global actually could be a negative headwind. So we could have 2 negative headwinds on bonds. But the yield is very decent. So we have got that, so we are overweight, and we do think that we're not going to have a horrible surprise in the budget, at least now in November. Come February next year, we're waiting for more data. If it looks like there's going to be a nasty surprise in that, not because of revenue, again, revenue is likely to surprise upside, but if there are some bad expense surprises, and they'd be like a universal income grant, which we can't afford, or national health insurance, which we can't afford, or nuclear power, which we can't afford. If those sort of things start creeping in, well, then that could be very bad for our bonds. But we haven't heard anything about that yet, and hopefully that won't happen, in which case bond yields should strengthen over the next 6 months. Andrew asks, is it time to start dumping fourth hour and FANG in favor of sole active health care? So we still have an allocation to fourth industrial revolution. We do think that if your time horizon is 5 years, you don't want to sell fourth hour and you don't want to sell FANG. Those are still great businesses that will grow market share despite slowing growth, and earnings will catch up to valuations. Yes, valuations are a bit stretched because of interest rates, and those valuations will come down as interest rates rise, but they're still great companies. So I wouldn't sell if you've got a 5-year time horizon. If you've got new cash coming in, yeah, we prefer emerging markets, prefer healthcare right now to the tech stocks, which will see some headwinds. Healthcare as well as a growth area, and generally value does better over the next 6 to 12 months than health. So that's why we have got a larger exposure to value and emerging markets than we do to health. In 6 or 12 months' time, that we'll probably rotate that back into all of our overweights being into tech and health, and small allocation to EM. But right now it's quite balanced. So again, depends on your time horizon. Don't sell off the RFN if you have a long-term time horizon. We do think that there are great places to be in the long term. I asked about robo-advisor. So robo-advisor is a great nifty tool. I like to think about it as Google Doctor. So, if you wake up and you've got one eye that doesn't work, with your other eye, you'll Google, why isn't my eye working? And it will give you 10 different reasons. Some of them will scare you to death, some of them won't. You'll get some sort of understanding, but then empowered with that knowledge, if your eye doesn't get better in the next day or two, you will go see your doctor. Robo-advisor is the same. So it's on our website. We've got 2 different versions, but it's really good. It allows you to put in, well, it's got some questions, and those questions are designed to try and work out your risk appetite, and then asks for it takes a little bit of time, asks for your expenses and your income, and it does what I can't do in this webinar. It then looks at your risk appetite, it looks at your income versus your expenses, it then looks at your time horizon, which I told you about, and combines all 3 to say, well, this is the amount of equities and bonds and cash you should have, this is how much global you should have, this is how much local you should have, and these are the Sygnia funds that best correspond to that. And then if you do pick to go that route, you can then invest solely through Robo. You go right to fruition, where you'll be given access to the funds and you'll invest in the funds. And I actually, myself and my colleague Ian, as head of investments, we sign off those. So any robo advice that is given by our robo advisor, we actually sign them off at the end of the day and before they're invested. But we don't find, probably 1 in 10 people actually go all the way to the end. Most people on robo tend to use it like Google Doctor, just try and get a feel for what their mix should be. It empowers you. So you go there, you learn a bit, you get some empowerment, so that when you meet with your financial advisor, you go, oh, but why did the robo advisor say I should have this and not that? And you at least then have the right questions to ask when it comes to your financial advisor. So I think it's a fantastic tool, either to go all the way through if you are comfortable, or just to give you some information so you know the right questions to ask when you get to your doctor or your financial advisor about your situation. So please do have a look at it. It's on our website. Play around with it. It does take some time and the more effort you put in and the more time you put in terms of a detailed analysis, the better answers you will get from it. Anything like any model, garbage in equals garbage out. But if you're prepared to put some time into it and you are looking to educate yourself, it is a great tool, and it has the full spectrum of Sygnia products to invest in. Mike asked another question about the divvy fund for retirees. So again, it depends on your asset mix. So I can't answer that question in terms of your asset mix. Some people, when they're retired, they only have the asset mix only allows bonds. They have to have guaranteed annuities with only bonds. Others have conservative living annuities, which also only has bonds and has quite a high yield. Others have more aggressive living annuities with a lower yield, and there are some equities. And if your living annuity or just your discretionary money, if you do have some equities and you are allowed to have equities, then the divvy fund is great in that it pays a good dividend. So it is quite good in terms of it's a RAND investment to match your RAND savings or RAND expenses that you need when you're retired. And it has a decent dividend yield, so it helps meet that ongoing cash need that you have. So depending on your asset balance, and certainly not as your only equity investment, but as a component of your equity investment, I think it's great for anybody, including people who are retired. So Wilhelm has a great question, and so we've had a lot of complaints about this in terms of the performance fee on the divvy fund. So the divvy fund we are changing the benchmark to the SWIX, and the philosophy doesn't change. So we will still be targeting high dividend stocks, low PE stocks, effectively value stocks, and we believe that those value stocks will outperform the market. And when they outperform the market, there will be a performance fee that's paid. So the performance fee is not relative to well, we're not tracking an index anymore. Actually, it's becoming an active fund. We're not tracking an index, but we're investing according to the same philosophy of high dividend yield stocks. And when those high dividend yield stocks outperform the market, well, then there's a performance fee paid. So it is, it is not, the benchmark is changing from the J259, which is the divvy index, to the SWIX. The investment philosophy stays the same, in that we're still investing in high dividend yield stocks. And when those high dividend yield stocks outperform the SWIX, well, that's in the performance fee. So, right now, the fund had, over the last year, outperformed its benchmark by 20%, and that's quite something. It's only if the fund continues to outperform and that 20% becomes 25% or 30% that you'll pay a performance fee. So, we really think that over the long term, value is the place to be. But if that gap shrinks and the divvy fund only does 10% of the next year and the market does 20%, well, you don't pay any fees at all. So it's very much a fee based on investment style and a belief in that style. And we do believe in that style, and that's why we back it, and we think that value will outperform the market. So you can, if you just like index tracking, broad index tracking, we do have our SWIX unit trust, so that just tracks the SWIX. We also have ETFs that track the SWIX 40 and the top 40. And Eva is going to be doing another webinar in 2 weeks on our Sygnia equity unit trust. And that is roughly half passive, tracking the SWIX index, and half active. And it's got our best blend of active managers, to which we've just added Visio. So we've got Visio, ABAX, Coronation, and 91. And the fee on that is phenomenal. We've just cut that fee by half. So instead of 90 basis points, that fee is 50 basis points. You get access to some of the South African leading equity managers, and that at 50 basis points. So there's a lot of ways to invest in South African equities. You can go passive, broad equity passive, which is SWIX or SWIX 40 or top 40. You can go active blend with passive, and that's our Sygnia equity trust. That's half active managers, half passive, if you like active managers. Or you can go, if you like the value style and you don't want to pay 2% active fees to pick an active manager of one of the large houses, or you can get active management for free, and you're only paying a performance fee when the value style does well. Now, if you had to pick a value fund at one of the big houses, you'd be paying a massive management fee, and you'd still be paying a performance fee when the style does well. So you'd get it on both fronts. Whereas now, at least you only pay when you beat the market. You don't pay anything at all when you're not beating the market. So yeah, I hope that explains our rationale behind that. I do think it's a phenomenal deal in terms of zero fee equity fund. It's the only zero equity fee fund that I'm aware of. There's management fee. You only pay if the fund beats the SWIX benchmark. So you only pay if you're beating the market. If you're not beating the market, you pay nothing. What more could you want? So it's all I'd want if I was an investor. You're paying for an active style. You're paying for the value style. If that style works, sure, pay for it. If that style doesn't work, pay nothing, zero, until that cycle comes. And value certainly does work in cycles. You know, it does well for 8 years, and it does poorly for 8 years. And you know, why pay management fees for all that time in these cycles when it doesn't actually all work? There was another last question just on South African bonds. Yes, they had a bad month in September, driven by global bonds, driven by tapering. So our bonds not immune to the taper recalibration that happened, and there will be some more headwinds. But I think that there was also so September was a bit of a scare. I think there'll be a more measured pace to the rise in US yields. You know, we only think they're going to go from 1.5, maybe 1.8 over the next 6 to 12 months. Half of that was done this month, 1.2 to 1.5. So we think that there won't be as negative impact on bonds, South African bonds going forward, more of a neutral impact. So not too concerned over the next 6 to 12 months on bond yields, provided that the budget goes according to plan. Probably not great return, probably not any strengthening in our bond yields because of the global headwinds. But as long as bond yields stay relatively flat, you're going to earn your yield of 9%. You know, that's more than double cash. So you can afford a bit of volatility. Or if you can afford a bit of volatility, you can earn double the yield. So that's why we are overweight those bonds. Yes, so more questions on the divvy fund. So just explains the divvy A class continues, no change to the A class. That's 35 basis points fee, unchanged. The B class is a zero management fee class. That is zero now. It's currently got zero performance fee because we have to ballot the investors to get that approved. And once that is approved, then from that date going forward, there will then be a performance fee on that, only that class, only the B class relative to the SWICs. More questions on the divvy, but hopefully I've answered all of those. Yes, we're also looking forward to the SA-focused infrastructure fund. We're not launching it as an ETF at this point in time because the regulations don't allow us. So it'll be launched on the life side. But we are very excited about that. So there has again been a slowdown on that side. I said we invest in infrastructure projects as they come online. There's been a 4-month delay to the emergency power projects because of the legal actions around car power ships. And I'm very happy about that because that's certainly one we're not going to back when it comes to investing in. But that has delayed all of those projects. So unfortunately, cash is sitting there waiting to invest in infrastructure, but the projects are a bit slower. There are some other opportunities which have come up and could happen sooner, which we're excited about. I'll definitely keep you posted on that. Question on cryptos, I have no idea. It's something, in theory, crypto should be linked to gold and global bonds as a safe haven, as a dollar equivalent, but they're not. Volatility is sky high compared to them, so I don't understand them. They don't do badly when gold and the markets do badly. They had an idiosyncratic event this month where China banned crypto again. I mean, this is like the 7th time, but crypto has been banned 1 million times in China. It gets more and more banned every time. But crypto fell as a result, but still well above what I read as the fundamental value. But again, it's when you have non-fungible tokens trading at crazy prices, that whole world is something that I don't fully understand. My best guess is that people who have been in crypto a long time have made a lot of money, and good for them. I'm not one of them, but I think those people who've made so much money, it's become a bit esoteric, and they're prepared to buy non-fungible tokens with no meaning at crazy prices because it's all wrapped up in something that's a bit not linked to fundamentals. I mean, it's as kind as I can be. So we are still looking at launching retail products for people who believe in that, to give greater access to that. Our biggest hurdle is credit. We want to make sure that your money doesn't disappear in terms of where that money is held. So we're working on it. The regulator is not helping. The JSE is not helping. Everyone wants it to be done properly and correctly, so that is making it harder. But as soon as we can convince the regulators that it is safe from a credit perspective, not that Bitcoin won't fall, but that your money won't disappear somewhere, like has happened numerous times, well, then we will let you know. Tapering is the act of buying less bonds. So it's central banks QE at a reduced rate. So instead of buying 100 million or 100 billion this month, they buy 50 billion next month. That's tapering. So it's not selling. It's not even stopping buying and allowing to mature. It's still buying. We start off with buying, we buy less. Finally, we hopefully in the US we're at a point next year where they buy nothing. At that point, they're still replacing what matures. Then, and I don't think we'll ever get to a point where they stop replacing what's maturing as those bonds hit their maturity date. I don't think we'll ever get there. And then the final step, which I definitely don't think we'll see, is actually selling. It's just to get to that point. Yeah, the last time it happened, there was a massive market drought. 2013 taper tantrum. Yeah, and then terrible things could happen to gold and bonds and equities. So I'm hoping we don't get there. I don't think the market will let us get there. I think the market will correct before we can get to that point. I think I've answered the question on tech and FANGs over a 3-year time horizon. I think they are great, that earnings will catch up with valuations. But over the next 12 to 24 months, you're going to have earnings going up because they are great companies, but you're going to have the valuations coming down as interest rates normalize those valuations. And so you're going to have these bit of the headwinds. It will lead to increased volatility. Overall, yes, they will go up because the earnings will grow faster than the valuations will decrease, but they're better places to put your money in the short term. That's my bottom line. New cash in the short term, better places, but over the next 36 months, they will do well. So that's we don't avoid. Yes, I'm very sorry, Niels, about our SARB limits and living annuities. We should have an update soon. I know I keep saying that every time. We are waiting for the final number to give to the SARB. It looks like it is going to be below 40, and I think we'll be opening that up. It's just to what extent we open it up, and whether we open up and keep it at 40 or open up and raise it to 45%, I'm not sure. But please keep in contact with us and the retail team. There should be news soon, I hope. I keep promising it to you, but it really should happen this month. There should be news on that. So in fact, Niels, send me an email, and I'll make sure that someone gets back to you on that in terms of where you're sitting, in terms of your investments with Sygnia, and how we can help get you to a high level. And then running out of time, so just one last question on the Rand dollar. The Rand has been quite weak, and that's part of the taper tantrum, recalibration, whatever else has happened. I think going into the end of the year, markets will recover. We are seeing this as a dip buying opportunity, not only for equities, but also for the Rand. So we maintain our 14.5 Rand towards the end of the year. So we do think the Rand will strengthen from these levels. But if we're looking at a year out, the Rand will be back at these levels. So our 1 year forecast is probably 15.5 or even slightly weaker. But should get stronger before it gets weaker is our bet. But if you've got a 12-year view, the Rand is likely to weaken. And sorry, one last question from Barry. Yeah, Barry, unfortunately, so you've got your 1/3 cash payout from your annuity. If you only need the money in 5 years' time, then depending on your risk appetite and depending on your other needs for your cash flow, but if that cash doesn't need to be touched for 5 years, then you can afford to worry more about inflation risk than capital risk. And then certainly there should be for that money, at least 70% equities, maybe look at skeleton balance 70, or maybe even more equities if your risk appetite allows. But that's something you can have a look at on the robo-advisor to see what your risk appetite says, or speak to your financial advisor to get your best blend. But yeah, but beyond 5 years, inflation risk is your main concern. Less than 1 year, capital risk is your main concern, and that impacts the asset classes accordingly. Okay, 1.5 hours. Sorry to have kept you so long. Yeah, I hope everybody has a great October, and I look forward to seeing you all in November. Cheers.